Hey guys, it's Melissa with the Coutz Group again. Just giving you a quick update on interest rates. So, what we're seeing this week and last week is that they are starting to make some significant jumps. Earlier in January, we were looking at kind of like that 3.25, 3.325. And as of a couple Fridays ago, we saw them jump into 3.6. And even as of today, Thursday, January 20th, and into Friday, January 21st, we're also seeing them start to increase. Kind of got to look into the fours. So that is kind of happening with certain types of loan programs. Now, as always, points, discounts, all of that stuff is still available to lower those down. But what does that mean for our market? We've had a lot of our clients reach out and ask, is this going to diminish the seller's market? Like, is this going to slow things down? And the answer to that is yes. Like, it is meant to kind of, battle inflation, if you will. That's why the Fed is doing what they're doing. But what we see in parts of like the real estate market is that when that interest rate kind of goes up, we are really going to be looking at affordability for a buyer and for a seller to maybe move up. And that affordability can hinder, that buyer's power to be able to purchase that new home. So as of these past couple of years, we're seeing that first time home buyer bracket, depending on the area, shift up to like being in the 100,000 to 200,000 low twos. Well, first time home buyer now is low twos to threes and potentially fours in certain areas. So it's going to be interesting to watch that interest rate and what it does and as it goes up, because it does actually increase that purchasing power and what that monthly payment breaks down to be. So with anything, talk to a lender on how points or anything may actually help you. And maybe you don't have points. It just depends on each situation and each house. Now, as far as that term comes into play with like the economics of like, is the higher interest rate going to take us out of the seller's market? Is it going to diminish what we have going on? And the answer to that is no, not immediately. And here's why. Part of the issue is that it all comes down to inventory. So when we look at like, is it a buyer's market or is it a seller's market? We kind of look at what's called days of inventory. So what we do is we'll take a certain area, we mainly base it off of school district, and we look at how many active homes are there versus how many houses have sold in that school district over the course of this past year. And when we kind of take those numbers and we look at them, we actually develop what we call the days of inventory. And that lets us know how many houses are on the market, like how many houses are on the market that feed the current demand of people wanting to buy houses. So for instance, right now, like City of Noblesville is at 7 days of inventory, which means that potentially you could run out of inventory if nothing new came on the market. Like that's how low that is. To put this in perspective, when we reach into a buyer's market, that means 180 days plus. So 180 days is kind of what we call as that neutral zone, where you have anything under, it's technically considered a seller's market, which is what we have been in since I would say probably like 2014, 13, right around there, turning in after that financial crisis. Anything at 180, right around there, is what we call the neutral zone. Anything over that 180 starts to get into that buyer's market, meaning buyer holds all the power. So because days of inventory are still down in single digits in some areas, double digits in others, we're still not even close to the triple digit, which is when we start seeing that shift into that neutral territory. So until we start getting more inventory under our belts, we will still stay in a seller's market. Other factors can play, and we can see shifts start to swing. So we have seen some shifts go in like the 2-3 year mark, but one of the big difference makers of right now, and a lot of people are asking, when is it going to crash? When is '08 going to happen? Well, it's not. It's not as of right now, because we actually have what's called as like an actual demand. In 2007 and 8 and leading up to that, lenders, bankers, we can all get into this, and this could be a full another hour long episode. basically we created this false demand by issuing bad loans and kind of bundling those up into CDOs and giving them higher ratings than what they actually were. So that kind of created that false demand. And then we started seeing a ton of bank loans enter the market. So when all of those people stopped paying because they were issued loans that they couldn't afford, that rush of bank loans took inventory levels from like a low, skyrocketing them up. Literally, bank loans flooded the market, which then shifted us drastically from being maybe into that seller's market, balance market, all the way into a buyer's market in the matter of no time. And that's kind of the '08 in like a super, super tight nutshell, not even diving into other ins and outs of it. So, but post financial crisis, what happens then you have this rush of bank loans. Well, there was not any development of new construction. So, because new construction just kind of like dipped and then flatlined, there hasn't been enough homes being built over these past couple years to even keep up with the demand right now, which is why we're starting to see what we're seeing with like the new construction being and everything just booming right now, because we're trying to keep up with that demand. So when inventories are low and days on market are still low, that's an indicator that we are still in that seller's market and we're not going anywhere quickly until we start seeing that inventory number really start to jump. So as soon as inventory starts to jump, that's when we start seeing that to teeter. Now, that's going to be the thing, is that interest rates, that's going to be able to drive that demand a little bit, because that is, again, the buyer's ability to purchase the next house, or either they're up, their move up, their downgrade, their first time. The interest rate can help drive that buyer's ability to purchase, which can drive demand. It will not help with the supply until we're either A, more people come on the market, B, we build more inventory. So, meaning new construction. So that's kind of it with interest rates and how that's looking for our market right now. Obviously, things are subject to change, but feel free to reach out to us if you guys do have any questions, or if you guys want to know what the days of inventory are in your own area. So we will talk to you soon, and thanks for listening.